All right, welcome everybody. Thank you so much for joining us today on a Tuesday night. Appreciate you all being here. We're going to go through a quick presentation why this is the best window to get into the multifamily world since 2010. And we've got Dwaine Clarke here and myself. I'm Nizan Mosery. Thank you so much for being here. And again, this is just so everybody knows this is for educational purposes only. We are not offering any securities or anything of that nature right now. And what I would say is that if you have questions, do me a favor. Oh, type them up in the Q&A section, and I assume Dwaine, you'll keep an eye monitoring that and participants coming in. So we're going to do about a 45 minute presentation, then we'll open up for Q&A. But in the meantime, as we go along, if you do have questions, feel free to type them in that Q&A, and hopefully we'll answer your questions as we go along. And if not, we'll open it up later for Q&A. A little bit about myself. Let's see. Which side? Let's see. I'm not sure okay, there we go. Yep. Back that way. There we go. So who is this for, this webinar? So this webinar is for three types of people. It's basically for busy professionals and business owners who want passive real estate income without active management. And that's what we talk about, right? We're here in the multifamily space. We're doing a lot of syndications where it's pretty much a done for you opportunity, right? We go out, we source great markets to invest in, we source great opportunities, properties, we do the due diligence, we do the inspections, we'll negotiate with the sellers the best possible price, and then we'll raise capital and we'll go out and we'll manage the assets, and we'll make sure that the property management company is doing what we want them to do, and then we'll pay out quarterly distributions and we move on down the road. So this is a pretty much done for you project without anyone having to deal with toilets and tenants. This is also for active real estate investors ready to transition from direct ownership to a limited partner position in larger institutional quality deals. This is also where your money has a bigger bang for its buck, right? If you've got 50K, 100K sitting in your bank account, what can you buy today with that, right? There's not a lot of deals that you can buy, but when we pool it together, we can go out and buy multi-million-dollar assets. It reduces the risk profile for people, and we can go out and we can position ourselves with larger institutional size quality properties. This is also for sophisticated investors who recognize market cycles and don't want to miss the repricing window. We're coming into a perfect storm that we haven't seen in a long time. And it's pretty amazing what's going on. A little bit about myself. I'm the conscious investor. I've been 15 years in the multifamily investing space. I've been in real estate a lot longer than that. I've transacted on 2,000 plus units. I've got around 1,500 units in different asset classes, going from commercial office space to hospitality, multifamily, and student housing. I've transacted on over about $160 million worth of multifamily and student housing with my commercial and hospitality. I have about 200 million plus in assets under ownership right now. I've gone multiple full cycle value add deals. I've done around 13 deals full cycle. And I'm known for being a conservative underwriter and operations first focus. A lot of our previous investors, what they like about me is that I'm very hands-on. Go to the properties a lot, do a lot of surprise visits to the property managers. They don't necessarily like it, but that's what we do. We surprise them, make sure that everything's going smooth. I'm also a mentor and a coach. And as you can see here, this is some of our weekend boot camps that we hold to teach people how to go out and do what we do. My philosophy is to give back to the community as much as the community has given back to me. And one of my philosophies is no one left behind. So I want to help as many people as I can reach and achieve massive success. So let's go into it. And we have Dwaine Clarke, Essential Realty Capital, American Net Lease. He founded American Net Lease in 2012. He's focusing on single tenant essential retail properties nationwide. Those are triple net deals. He's got $400 million in commercial real estate transactions in 40 states, representing primarily buyers and investors. He's done over 150 transactions. And he's known as a true matchmaker, connecting investors with high quality income producing assets across the country, pairing the right opportunities with the right investors. And there he is. There's Dwaine and myself in our last event in May that we had in South Florida. And by the way, we're going to have another 2-day multifamily accelerator event coming up in February in the Tampa Bay area. We'll be sending out more information about that later on. So, webinar agenda. What we're going to cover tonight, where we are in the rate and debt cycle, the macro setup, why multifamily demand remains structurally strong despite the headlines, and how the maturity wall and higher rates create distress. We're going to talk about market frameworks and 10 focus markets, where to deploy and where we're looking at right now. Underwriting guardrails, how we protect capital, and how sophisticated LPs are positioning themselves. What smart money is doing. What are the Blackstones and the Pebbles and the Rocks and all these big funds? What are they doing? And then we're going to talk about next steps and Q&A, how to stay in the loop. So again, 45 minutes, hopefully we'll get it done a little bit sooner, and then we'll open up for questions and answers. So let me give you the 30,000 foot view of why we're here, right? So 3 things happened simultaneously that created this big tsunami that we see coming down. In the last couple of years, we've had the fastest rate hike cycle in the last 40 years. The cost of capital went up. The Federal Reserve executed the fastest rate hiking cycle in over 40 years, approximately 500 basis points in 16 months. That's unprecedented. It actually disrupted the market completely, put the market on its head. Second, we have about $2.2 trillion, that's trillion with a T, in commercial real estate loans maturing in between 2025 and 2027. And this is the breakdown. We've got $957 billion of debt that came due in 2025. We've got $1.15 trillion coming due next year. And in 2027, we've got $1.26 trillion coming due. That's the peak, right? Many loans originated at 3 to 4% back in 2020, 2021, right? During the pandemic, when pricing went up and interest rates dropped. Now what's happening is that these rates are refinancing at a 6 to 7% interest rate, right? That math is brutal. And a property that could previously support, 75 to 80% loan to value at a 4% can now only support maybe a 55 to 60% loan to value at a much higher 6 to 7% interest rate. So that's what we call an equity gap. And that gap is our opportunity, right? That's what happens, right? So here we see on the bottom, in 2021, easy money, aggressive underwriting, people were buying at a 3 cap, at 3% interest rates. Then things started to happen. Interest rates started going up. People started buying in on bridge notes, right? That were fluctuating. They weren't stable. And then between 2025, this is when the opportunity is. This is when things are going, where we're going to see the correction happening, right? And remember, it's not about bad real estate. It's about good real estate with 2021 capital structures that actually don't work in the 2025 rate environment. And that's the opportunity, right? So what we saw interest rates go down. We saw pricing go up, cap rates go down. There was a buying frenzy. People bought because money was basically free. Now these loans are coming due. people can't refinance because the value isn't there. Cap rates went up, right? Now they're looking and going, wait a minute, what are we going to do? We can't refinance. Interest rates are still high. So now they either have to come up and they have to, they got to either bring in capital. They got to do a lot of capital calls, or they got to sell for what the debt is on the property. And what we've seen is that even the debt is still too high for the cash flow, because what happens when interest rates go up? It eats up all of your cash flow. So there's nothing to give to the investors, and there's no way to refinance a property at those rates. So that's what happens, and this is, and we call it the rate shock in context. Let me share with you what happened in March 2022. The Fed funds rate was around 0.25%. It was almost zero, and we can see it right down here, right? You can see the Fed rate is that light blue line right here. It was at the bottom, right? This is where people were buying. It was a buying frenzy, right? But by July 2023, you can see that, and it was just 16 months later, it hit 5.5% interest rate. Boom, right here. Look at that. It went up. It went all the way from the low, from about half a point all the way up to 5.5. That is a huge shock to the industry, right? And that happened in 16 months. That's the fastest hiking cycle since the early 1980s, when I don't know how old you guys are, but Paul Volcker, he was trying to break inflation, just what we're trying to do now. The impact for multifamily specifically was agency debt. Your Fannie and Freddie Mac loans, they went from 3.4% to about 5.5% to 6.5%. And bridge loans, right? That's the dark blue line, right? Bridge loans, they went from 2.5%, 3.5% all the way up to 7 to 9%. Think about again what that does for your cash flow. It reduces the cash flow. It almost destroys your cash flow. Plus, we have real estate taxes going up. We had interest rates insurance rates go up. That eats more of your capital stack, of your cash flow. So properties now, looking back, they're sucking wind for lack of a better, for lack of a better term. They're really sucking wind. So the opportunity here is in 2021, we saw a stabilized Class A multifamily asset in a good Sunbelt market might have traded at a 4 cap, right? But today, that same asset, it's trading at a 5.5 and 6 cap rate, and it has to make, because that's how it can make the debt service work. That's a 25 to 35% value decline. The problem is that many sellers still have their heads way up there, and they're anchored in the 2021 pricing. People still think we're in 2021. They still think that, my property is still worth what I paid for it in 2021. And it's not. That's not the way it is. And that's what's been going on these last couple of years, right? So the maturity wall forces the price discovery, right? When you have to refinance or sell, suddenly, sellers are going, wait a minute, I can't sell because the value's not there. What do we do? Either we bring capital in, or we have to sell for a huge price reduction, right? And that's what we're seeing here. Fed funds rate, right? March 2022 to July 2023, it went from 0.25% to 5.5%. It shocked the system, right? That's that red line right there. And then kicking up by July 23, look where it goes. It went all the way up, and that's where it stayed. And then the 10-year treasury went from 1.5 to 5. Look how it went. That cycle just went up. And then multifamily loans, which were right here, they were hovering right around the 2.5%, 3%. They went all the way up to 6.5%. So when interest rates go up, you can't refi because the cash flow is not there. And that's what screwed the entire industry. And all this happened in about 16 months. Complete and utter shock, right? So let's look at that maturity wall itself, right? Now, this is pretty much not a prediction. This is what happened. This is we're showing you live what's going on, right? So in 2024, we had $785 billion of debt coming due. In 2025, it went up to $957 billion. Now it's going up to 1.15 trillion this coming year. That's loans coming due. Values where these properties, where these owners bought properties 3, 4, 5 years ago, the value is not there anymore. The value went down and these loans are coming due. In 2027, we've got $1.26 trillion of debt coming due. And look what it says here. Originated at 3 to 4% rate between 2015 and 2022. They're refinancing at a 6 to 7% interest rate. The value is going down. And then you see now going down again, $890 billion. So most of these loans, as I mentioned before, originated between 2015 and 2022, where rates were 3 to 4%. And they're now these borrowers, they're not refinancing into a slightly higher rate. They're refinancing into a world that's double or triple their cost of capital. It totally wipes out their cash flow, and it totally wipes out the opportunity to refinance. So when that happens, three things occur. They'll either write a massive check to fill the equity gap, a 6-7 figure check. They'll sell it at a discount, at a deep, deep discount. And I'm seeing more and more of that coming due. We actually went to Arkansas, Little Rock, and we saw a property where the sellers were selling it. They were distressed. They sold it for less than what they bought it at. They didn't keep the property up, the condition of the property up. So when we saw it, we had to retrade because the CapEx, the renovations were more than what we were told. And we reduced the price even more. They said no. The bank took it over, and now the bank is selling that. More and more I'm seeing coming on the market, lender-owned sales, meaning that these lenders are now taking over properties and they're bringing them back to market. And this is our opportunity, right? This is our opportunities. And when all these three happen, it creates, like I said, an opportunity for us and people with dry powder and with a little bit of discipline to be able to buy correctly. This is a win-win-win scenario for us. This is the tsunami that's coming. It's actually already here. It's like you see those waves that they start slowly, and they start building up and building up. Now is the time to make sure that we've got all our balls in play, all our T's are crossed, all our I's are dotted, so that we're prepared for this huge influx of properties to come on the market. I'm super excited for this. This is it's sort of another 2008 crash, but very different because we're not dealing with bad properties. We're not dealing with low occupancy. We're not dealing with anything like that. We're dealing with bad capital structure, which is a completely different animal. So basically the multifamily share of the wall, right? So, multifamily represents about 23%, as you can see here, of the maturity wall in securitized debt. That's neck and neck with office at 24%. But here's what makes multifamily fundamentally different from office, right? The distress is entirely different in nature, okay? Office buildings have demand problems. People aren't going back to offices built in 1985, the 1990s. They're staying home, right? Maybe some companies are calling people back to the office, but they're having to renovate these offices. Offices are shrinking as well. It's a secular decline, but people still and will always need a place to live, no matter what. And that's why multifamily is recession-proof and inflation-proof. They will always need a place to live. And it creates a very different investment opportunity. See, we're not trying to catch a falling knife or bet on a secular turnaround. We're stepping in when good assets with strong rental demand hit temporary financing distress, right? We're not, and we've seen it across the board. A lot of people are buying 1980s office product, converting them to multifamily. We're seeing a lot of people buying hospitality, converting them into multifamily, because multifamily during those several years that we just came through, that the pricing was so high, interest rates were so high, it didn't make sense to buy. And that's kind of staved off a lot of people from buying multifamily properties. But now we're coming in now, right? We're in December. Next, I think this Friday, we're due to hear if the Feds are going to do another rate drop. I'm hoping that it happens. We're looking at that market and saying, you know, it could be. And then in 2026, we're looking for more rate drops. And if that happens, more buying frenzy. And then these distressed loans coming on the market. We got to be prepared. And that's what we are preparing for. Let's talk about transaction volume and pricing reset, right? So let's talk about what actually happened. You can see on the left that apartment sales volume collapsed from $350 billion in 2021 to around $125 billion in 2024. There was, I think, if I remember correctly, there was only about 4,000 transactions in 2024 of multifamily properties, which is nothing. The multifamily market ceased. It stopped because of this. Look, 350 billion versus 290 billion, 150 billion, 125 billion. Now, this past year, when interest rates started to go back down, there's a recovery phase, right? And if you know the emerging market cycles, if you know how the cycle works, look at the cycle. We peaked at sales volume. Then it declined. This was the bottom. And in 2025, we started to see a recovery. This is when we start coming out of the slump, right? Now, this happened because of what was, the bid-ask spread paralysis, right? Again, sellers thought they were still in 2021 prices, right? But by what we can only pay a certain amount of purchase price because of interest rates and where cap rates were, right? On the right, you can see cap rates have expanded from 4.2% in 2021 to about 5.7 to 6% in today's market, obviously, depending on the market that we're talking about. That's between 130 to 180 basis points. Now, check this out. Every 100 basis points of cap rate expansion is roughly a 15 to 20% price decline, where everything else remains the same, is equal, right? And we have anywhere between 130 to 180 basis points. But here's the critical insight, right? We're still early in the phase. We're still early in the recovery phase. It's not like we're bouncing back and we're bouncing back strong, right? And you can see here, transaction volume went down 60+% from the peak, okay? And again, why? Because many sellers were still anchored back in those days when they're saying my property's worth X when it really isn't. And they're going to get smacked in the face when they go to refi and the value isn't there. And it's happening to everyone today, right? Now, a lot of these people that bought in 21 and 2022, they still have about 12 to 24 months left on their loans. They're hoping and praying that rates drop so that they can refi out. However, remember the other slides that I showed you, there's already $1 trillion of debt that's already coming due. It's already there. There's no chance of them to refi at that point. So now this is when we see, right, sellers start dropping their prices. This is what's happening. The opportunity you'll see is real price discounts, right? Sellers will stop anchoring back into 2021 and they'll start realizing what they need to do if they don't want to write those 7-figure checks coming in the deal with equity, right? Then nobody wants to do capital calls, right? It sucks for everyone, but that's what's happening in the market. So now let's talk about, before we talk more multifamily, we have to understand that when cycles shift, it happens in single family first and it transitions into multifamily. And we can see what's going on in the market when we look at single family. right? Existing home sales were running around about 4 million units annually. And that's the lowest level we've seen since 1995. Of course, we're not talking about the 2008, 2010 crisis, right? But the market is basically frozen. Now, why is it frozen? 83% of homeowners right now have mortgage rates under 5%. 60% of them have mortgage rates under 4%. Why would they sell? Why would they refi? Why would they do anything? Right? So they're frozen. They're not going anywhere. And also, what it means now, if you look, the median first-time home buyer's age has increased. I think it was 33 or 35 years of age. Now it's somewhere around 40 years of age. What does that tell you? More people are renting longer. Less people are buying homes. That's great for us. That's another driving factor why we want to get into multifamily and how that metric will stabilize multifamily. So let's do the math, right? Let's say you bought a home in 2020 at $400,000 at 3% interest rate, right? Your mortgage payment is around $1,686 a month. Now, in 2025, you buy that same house, you buy it at $450,000 at a 6.8% interest, at a 6% interest rate, whatever it is. It's not 3% the way it was. Your mortgage payment is now $2,934. Why would you want to do that to yourself? That's a 74% increase in monthly payment, right? What's the effect? Golden handcuffs. We've got captive renters staying put a lot longer. This creates massive rate lock, right? People who normally move every 5 to 7 years, they're staying put for 10 to 15 years. That means fewer homes are selling, less household mobility, more people stuck renting longer than they'd prefer, which again is a good, it's a good metric for us. Longer apartment lease durations, right? So for multifamily operators, it's actually positive. More stable tenancy, less turnover costs, less people leaving because now they're buying homes. They're staying put longer, right? It also means that the single family market isn't providing its normal pressure valve function, right? So we also have to keep an eye on that multifamily space, on that single family market to make sure to see what goes on there. Okay. Now let's talk about the multifamily demand versus vacancy, right? So let's talk about what's actually happening. We've heard the headlines: multifamily vacancy is elevated, right? We hear that a lot going, all these different publications. But let's break down what that really means, right? So the national vacancy peaked at about 6.25%. That's the star right here, right? In Q1 of 2025. Currently, it's between 6 to 6.5%. Now, that's not crazy. It's still high 90s or mid 90s. We're still okay. We're still stable. But we can see that vacancy did grow. But here's what matters. In the luxury Class A world, right, the stuff that was delivered in the last 2-3 years, right, there was a lot of delivery of units. I'll give you an example. The Texas market, there was a lot of influx of new delivery of units. Now the vacancy rate is increased because they're waiting for these units to get absorbed. They're waiting for people to go in and occupy these units. That's why we're seeing a lot of concessions in these markets, right? We're seeing, vacancies sitting at around 11.4% with basically zero rent growth, right? And these properties are offering. We saw a property when we had our workshop in May. We saw a property here in South Florida that they're giving high concessions so that people can occupy, because these are properties that were brought onto market. What happened? Their cost went up. They have to now increase their rents so that they can stabilize. These developers want to get out of these assets. They want to get out of their high interest rate construction loans. They got to stabilize it so they can sell them. They're giving a lot of concessions. They're reducing their rental rates, their vacancies going down. So there's a lot of things going on with these newly delivered asset classes, right? But here's the key. Here's the rub. B and C class properties. This is where value add investors operate. This is where we operate at, right? We're seeing 7.3% vacancy with 1.3 to 2.6% rent growth. That's only 180 basis points above normal, and it's falling. So what's the narrative? The narrative is multifamily is oversupplied. Well, technically true, depending on the asset class, right? But it's very concentrated in the luxury segment, like I just mentioned, right? The workforce housing segment, which we're going to be investing in, has a much healthier fundamentals, right? You can see here on the bottom, 7.3% vacancy and the rent growth, where Class A is 11.4% vacancy with 0.2% rent growth. So we're going in and we're buying these B class properties or C plus B minus, throwing in value, increasing rents, and our occupancy is still strong, right? Demand is not the problem. Okay. Net absorption in 2024 was around 420,000 units, and that's above historical average. The problem, and I'm going to show you on this next slide, the problem is absorption, right? The problem is what deliveries were. Let me see. How can I, there we go. Right? So you can see new construction starts, right? In 2021, we had 500,000 units. In 2022, we had 530,000 units. In 2023, 460,000 units. Now watch how construction starts, new construction beginnings starts to decline. 240,000 units. Now between 2026 and 2027, we have 200 to 220,000 units being constructed. 74% decline from the peak. Deliveries, look at deliveries. 440,000. 2024, we had 550 to 600,000, and it starts to go down and down to where 2026, we've got 300,000 units that are being delivered. And in 2027, we have approximately 220,000 units that are being delivered. And this is what it looks like. Now, remember that cycle. So we have new construction starts at its peak, 530,000 units in 2022. But now look at that. It starts to decline, right? 74% decline this year. We had peak deliveries. Deliveries went up in 2022, dropped a little bit, stayed stable, and then it peaked again in 2024. And look at this massive drop of deliveries. This is where you want to be. This is the bottom of the cycle, so in a manner of speaking. And where do we want to be when we're starting to acquire properties? We want to be at the bottom of the cycle when things start to go up, right? And if you look at, we came out of a 2008 market crash. It takes about 15 years from crash to crash, from peak to peak, from bottom to bottom. And we're now at 2010, 24. That's about a 15-year cycle. So we're right at the place where we need to be to start acquiring properties. Now we can talk a little bit about market sectors. We'll breeze through this. We got a lot more to talk about, but the office sector, limited buyers, negative absorption, we want to avoid. Retail, very selective, right? A lot of shops are going out of business because we have online sales and so forth. We want to be very selective in very select markets. Industrial, 2020, when multifamily was hot, people went and shifted and bought industrial. E-commerce, all of that, it's great, but it's very, very crowded. Cap rates are compressing there as well. And remember, when there's a recession, when things start to bottom out, what do people do? They start selling off their toys. They get rid of their storage facilities. They start downsizing their warehousing. They start downsizing the office. But what do people always need to have? It's a place to live. And when you buy correctly, when you buy on a conservative basis, you can win. And that's what we're doing. And again, why multifamily wins? Demographic tailwind, single family market frozen, as we talked about, supply wave ending, which creates scarcity. So people are now absorbing all of these new units that are coming to market. What's going to happen? No more demand. Well, demand is going to go up. Economics 101, supply and demand. Supply goes down, demand goes up, pricing goes up. That's what's happening in the market, and that's what we're seeing. So let's give a hypothetical here of a stressed 2021 deal, right? So someone bought a 2021 property, let's say for $50 million at a 4 cap. You got a $2 million NOI. Their debt is $40 million on a bridge loan, 75% LTV, loan to value. Their rate is, again, it's bridge. So it's a SOFR plus 300 points. Back in 2021, it was about half a point. So they're at 3.5% interest all in. Their debt service is $1.4 million annually. Their debt coverage ratio is 1.43, which is really strong. Their business plan was to do $4 million of renovations, grow their NOI to $2.8 million in 3 years, exit at a 4.25 cap rate, right? For $66 million in value, projected IRR 18 to 22% on paper, looks beautiful. Who won't invest in that deal, right? Now, come 2024, 2025, interest rates shoot up, especially on the bridge. These rates are variable, right? They fluctuate with the market. Your actual NOI now is 2.3. It's not 2.8. Insurance goes through the roof, increase about 40 to 60%. Property tax resets at higher value. Utilities and payroll all go up. Rent growth goes down. It's flat, 1.2%. Your current debt cost is SOFR. SOFR went up, right? All the interest rates went up, plus 300. You're now at 7.25 instead of 3.5. Your debt service, your mortgage payment went from 1.4 million to 2.9 million annually. There goes all your cash flow. There goes all your free cash to be able to refi and to give distributions. Your debt coverage ratio, how many times your NOI covers the debt service, went from 1.43 times to 0.79%. You're technically in default right now. Property's underwater. Your rate cap, which if you were smart in this environment, you bought a rate cap, which means that your interest rate can't go higher than what you bought it at, expires. So now you got to buy a new rate cap at an 8%. That's another $400,000 to $600,000 that you got to shell out of pocket. Refinance reality, new lender will only provide $35 million, assuming a 1.25 debt coverage ratio at a 6.5% interest rate. Your equity gap is $5 million. You lost money. This is what's been going on, and this is what's happening in the entire market right now. It's hard to be excited about this because you don't want to be happy for someone else's misfortunes. However, these last couple of years, I stood back in the market and we underwrote, and Doug could tell you, we underwrote hundreds and hundreds of deals, and we were being conservative because we knew this is what was going on in the market. And if it didn't pencil out, we weren't buying, and we didn't buy anything because of what goes on. Sometimes it's good to sit back and watch what happens, right? What's that famous saying? When people are fearful, be greedy. And when they're greedy, be fearful. People were extremely greedy between 2020 and 2025. And I was just watching. Now people are scared. What's going on in the market? These things coming up. So let's talk about the funding gap and sponsor pathways, right? So let me show you an example. We talked about this example. So the original loan balance was 40 million. The new lender proceeds 60% of LTV. Now, you have to cover the debt service, meaning if your net operating income went down, there's only so much debt service that you can get. And if you can't refi at that 40 million loan balance, right, what do? You either come up with $8 million capital call, and there's that gap, right? Who fills it? Either your investors or you sell at a loss and you take the hit, right? 2025 distressed multifamily activity, distressed sales up 100% year over year. REO dispositions 2.7 billion June 2025 versus 1.25 1 year prior. Rescue capital funds raising billions for this exact scenario. I'm seeing a lot now. There's these new lenders and these new groups coming, and they're calling themselves rescue capital. We'll come in. we'll do this, we'll do that, but we're going to take your equity. We're going to do all these things. But it's to save the asset, to save the sponsors, to save everybody from going into foreclosure. Is it ideal? Who knows? But this is an opportunity that we're seeing that we want to take advantage of, right? When, what do they say? When there's blood in the streets, right? Now there's a ton of blood in the streets. So what's the best buy window? The best buy window really means, well, we're not trying to time the exact bottom. We're not going to predict when rates will be perfect. We're not going to wait for maximum chaos. What we are positioning for is a multi-year window, right? Now the absorption, the deliveries are at the bottom. We're going to have a tsunami of loans that are maturing. So there's going to be a lot of assets. We're going to go into a buyer's market. Well, we're pretty much in a buyer's market right now. That's when it's time to strike. Strike while the iron is hot, right? We have forced sellers. Pricing has reset 20 to 30% from the peak. We can buy at below replacement cost, which is huge. We can negotiate investor-friendly terms. We can exit liquidity. Exit liquidity remains strong. These are the things that we're looking for, but it's a short window that we're going to buy in, right? This is when we're buying. So we want to be prepared. Our market classification. So before we reveal our 10 focus markets, I need to show you the framework we use to evaluate any market. We call this the 5-band framework, right? So we built this after studying markets outperformed which markets came out of 2008, 2012. The pattern was pretty clear, right? Markets that recovered first and strongest had three things in common: strong job growth and population growth, right? This is non-negotiable. This is what we look for, right? Job growth is the holy grail. Economic diversity. Single industry towns are dangerous. I bought a property in, I want to say 2011, around that time, in Houston. Houston at that time was a one economic factor. It was oil. That was it. We saw the shift moving from oil to natural gas. We saw price of the barrels going down. People were losing their jobs in the oil industry and so forth and so on. So we sold right when that shift was happening. We got out of it, and then we saw Houston tanked for a while, and then it came back up. Now Houston has multiple driving economic factors. And then the third thing is good exit liquidity. You need buyers when it's time to sell. So we're going into a market that has, I used to say 100,000. Now we've expanded that to about 200,000 people in the MSA. So bad markets, they're shrinking, they're stagnant with structural problems, right? Think the rustic belt cities with population decline, hostile regulatory environments, right? We don't invest here at all. Cautionary markets, 1.5% growth, single industry, heavy supply, pass. Mid markets, 1 to 2% growth, improving trajectory, possible. We'll check in there, right? Markets that have 2% plus growth, diverse jobs, landlord friendly, that's what we're shooting for. And the superstars, well, solid depth, institutional interest. They have big box retail, they have universities, right? They have major airport hubs. These are the criteria. And one of our we have on our team 1 out of 400 demographers in the country. Demographers study the movements of people, demographics, all of that. There's 400 of them in the entire country out of 350 million people. We have one of the top demographers on our team. And this is what we look for. And this is his criteria. And this is what we look at when we're buying in specific markets. And again, these are the classifications, right? Population decline, job losses, unemployment is 6% or higher, hostile landlord, tenant laws. We don't want to go into tenant-friendly states. We stay away from them, right? Our market classifications, right? The caution, and we went over this, so I don't have to repeat myself. The markets that we want to go in: population growth, 2% or higher for 2+ years consecutive. Job growth, 2.5% or greater. Economic diversity. landlord-friendly regulations, supply moderating. You know, this is where we want to be in. Why do we want to be in landlord-friendly states? Well, I had a single-family property in Florida. I rented it out to someone on a master lease option. We had two agreements. We had a lease and we had an option to buy several years down the road. When the option came due, he kept extending it, giving me more money and whatnot. But after a while, he stopped paying rent. His lease expired and his option to buy expired. We went to court. The judge asked him for two things. He goes, "Can I see the lease and your option contract?" He showed it. He showed them both. The judge looked at him. He says, "These are expired. Do you have anything that's current?" He goes, "No, I don't." He goes, "1 week, you're out." That's the strength about being in a landlord-friendly state. I also had properties in tenant-friendly states like New York City, where it would take us over a year to evict someone. Imagine not having income on a unit and then having to possibly pay for that person to leave for a year. You can go broke doing that. And superstar markets, deep into now. When you're buying a property, we're looking at the exit strategy first. Who are we going to sell it to? When are we going to sell it? What cap rates are we going to sell it? Is it going to be easy? So we want the deep institutional buyer pool. We want the pebbles, the rocks, all of the graystones, blackstones, all of these hedge funds, REITs. We want them to come in to buy from us. So we want to go into markets that have huge migration in them. And as I said, major universities, medical centers, tech hubs, big box retailers, right? If you don't want to spend millions of dollars on market research, go where the big box retailers are going because they spend millions of dollars. Think about it. If Starbucks is opening up in a neighborhood, they know that people in that neighborhood can afford a $7 cup of bad coffee. And that's just my opinion. You know, I'm a coffee snob, but if they can spend $7 on a cup of coffee, then they have money. Right. And this is where you want to go. You also want to go where you have the median household income is high and can cover the rent. At least 20% of their income should cover their rent, right? We look at minimum 30%, right? At least 30% of their household income should be able to cover the rent. That's what we look for. And I'll tell you something else. I was at a property. We were looking at a property here in South Florida. I was in the office and I heard the leasing agent talk to a tenant and they were filling out the application. And the leasing agent goes, "So from what I see here, your annual income is $12,000, not including tips. So $12,000 times 12 months, that's $14,400. The rent for a 1-bedroom unit was $1,540. How can she afford to pay to rent? Impossible. So we want to make sure that the household income can pay at least 30 the rent is 30% of the income, right? And what we look for, population, 5 to 10 year population trend, new household formation. Why new household formation? Because people stay. If they stay, that means that rent growth goes up, more jobs come in, people need a place to live. It feeds that job growth cycle, which then helps us maintain high occupancy. Jobs and income, job growth, preferably 2% or greater annually. Unemployment must be less than the U.S. average, right? It's currently 4.4%. Wage and household income growth, real wage growth. You want job growth to be higher than rental growth, okay? Economic diversity. You want different economic driving factors, right? You want healthcare, education, tech, industry, tourism, government. You want there to be an airport. Why do we like Northwest Arkansas? When I went into Northwest Arkansas about 3 years ago, they had a small airport. Ever since then, every time I go to Northwest Arkansas, for example, that airport is expanding and expanding and expanding. And every time I go, the GPS takes me through another route to get to my house because they're building new roads. They're building new shopping complexes, Top Golf, all these different things. They're building and building and building. That's where you want to be, right? In those types of markets. You want to be able to see the growth in front of your eyes. Infrastructure. Again, airports, interstates, exactly what I just said, major universities. As university grows in Northwest Arkansas, you have the University of Arkansas, the Razorbacks, right? 30, I think 33, 34,000 students. They don't have room to house their students. As student population student population grows, guess what? You need more people to run the university. You need more coffee shops. You need more restaurants, more bars to house, more service industry jobs growing. Guess what? People need a place to live. It feeds the job growth scenario. Housing supply and liquidity, units under construction versus existing. That's a red flag if it's greater than 8%. Vacancy and rent trends, you want to see the 3 to 5 year view. Days on the market for stabilized property, right? You want to see properties that are moving quickly, right? It's a good market. Price cut frequency indicates seller motivation, right? Policy and costs, property tax regime and assessment practices, insurance costs and availability. This is what we look for. State and local tax burden on residents, right? How much is it? Northwest Arkansas real estate taxes are pretty low, and we like that, right? Where we get the data, BLS.gov, Bureau of Labor Statistics for jobs and unemployment, U.S. Census Bureau, CoStar. It's one of the leading multifamily publications, and it gives you all of the information on the market. HUD, fair market rents, housing vouchers, local economic development councils, metro planning organizations, and on-the-ground brokers and property managers. These people are on the ground. They know what's going on. It's their job to know. Ask them questions, right? Our value add buy and fix sell model, right? We're not buying trophy assets for yield only income. We're not betting on pure cap rate compression, and we're not speculating on hope and change. What we are doing is we're targeting markets with growth and volatility. We're buying assets we can improve. We can improve operations. We can do unit renovations, amenity upgrades, curb appeal, resident experience, which reduces turnover, increases retention, premium pricing. What we do, we're maintaining multiple exit options, local, regional buyers, regional and private equity funds, public REITs. When we buy, this is what we look for. First, we look at our exit options. Then we look at what we can do to the property and where we can take rents. Return drivers, the basis. We're buying below replacement costs. We're looking at NOI growth, operational plus CapEx improvements, market recovery, rent growth as supply dries up, conservative leverage, right? We're preserving equity through the downturns. You can preserve your property. If you buy it correctly, it's all a matter of time. If you hold the property long enough, you can come back out of that downturn and be profitable, but you got to buy it right? We're not doing cap rate compression speculation. That's what got people in trouble, years and years ago. So focus market, tier 1, Raleigh, Durham, North Carolina, Charlotte, North Carolina, Huntsville, Alabama, Jacksonville, Florida. Tier 2, solid, Nashville, Tennessee, DFW suburbs, Texas, Phoenix suburbs, Austin suburbs, Atlanta, Georgia. T3 is selective, Tampa, inland Florida, only inland suburbs, right? So these are basically some markets that we're looking at currently. We're also looking in the Midwest, right? We're looking at Northwest Arkansas, Tulsa, Oklahoma City, Kansas City on the Missouri side. This is where we're really focusing on. These markets are still really solid, really hot, but you gotta have good boots on the ground to really identify where the areas are and where the opportunities lie. Whoops. Our underwriting guidelines, right? We don't invest unless, right? Sponsor has full cycle experience, track record of 10 plus deals minimum, demonstrated ability to handle distress and be able to pivot. Our conservative capital structure, well, we look for between 60 to 65% LTV. We may go up to 70%, but we don't want to be over leveraged, right? We underwrite to a 1.25, 1.3 debt coverage ratio so that we have a little bit of cushion. Stress test, can it survive a 1.15, assuming flat rents for 2 years, right? Maximum 7.5% all interest rate. This is what our stress test is on the properties. Robust reserves. 500 plus per unit minimum, operating reserves, 6 months of debt service. These are the things that we add in when we're underwriting so that we have a buffer if anything should go sideways, right? Sponsors, they co-invest. We have skin in the game. We also, what does a sponsor do? We sign on the loans. We're the guarantors. We bring in the 10, 15, 20 million, $30 million mortgage on our shoulders, and we make sure that we can service the debt, right? So the fee structure is anywhere between 2 to 5% on the acquisition fee, 1% to 1.5%. It's between 1 to 2% annual on asset management, depending on the property. There's a promote structure. We usually look at around the 7 to 8% pref. Now, again, it's the property dependent, right? These are just rough averages that we give. We do reporting on a quarterly financial basis, and when permitted, we do quarterly distributions as well. And then we have our annual audits that we do. What we do on the property side is we sit there and we talk on a weekly basis. As asset management, we communicate on a weekly basis with our property managers, our local managers on site. We communicate daily, and then weekly we have our on-site, we have our weekly property calls that we go over everything on the property: occupancy, vacancy, marketing, how many people toured, when did they come in, what were their reasons for not leasing, what was the income generated on a weekly basis, how much is delinquent, so forth, how many people are on evictions, on notice to vacate, what are the maintenance issues, so forth. Every week by week, we have these calls for all of our properties. And then when we exit, we look for multiple buyer types: local, regional, private equity, institutional, REITs, so forth. Market depth demonstrated by recent transaction volumes. And our hold period, depending on the cycle and where we are with interest rates and whatnot, it can be between, it was 3 to 5, because when interest rates were low, we had stronger cash flow. We were able to give more cash to the investors. However, as interest rates go up and the cash flow tightens, we have to extend that hold period to give investors stronger returns. But it can go between 5 to 7. It can extend 7 to 10. And there's possible refinancing during those years where we'll be able to give back all or a portion of the capital invested back to the investors. How sophisticated capital is positioning itself? Opportunity fund, raising billions specifically for distressed multifamily. We're targeting preferred equity and mezz debt at 12 to 15% returns. We're rotating out of challenged sectors, right? Office, retail, multifamily, and industrial, seeing increased allocations. So a lot of capital is moving back into the multifamily world. That's what we're seeing right now. And this is a great time to be in it. We're focusing on value add with better entry yields. We're emphasizing conservative underwriting. We're building in 12 to 18-month buffer zones before refi, increasing reserve requirements. We're doing all these things to make sure that if interest rates go back up, if there's another downturn, whatever it is, we can withstand anything. We're moving, like I said, from 3 to 5 to 5 to 7 years. We're negotiating extension options on debt. We're structuring LP agreements with patience built in. And what this means for you as an LP, well, how much capital do you want deployed into multifamily over 2025 and 2029? Consider this. This is a time-bound opportunity. Maturity wall clears by 2028 and 2029. The recommendation is we want to allocate early in the window now so that we take over these assets, and when the market starts to heat up and interest rates drop even more and cap rates compress and the market really heats up, we are now sellers, and people will come to us and we'll get these calls on a daily basis. Hey, do you want to sell your asset? And then it's a good time possibly to look at refinancing and continue to hold for cash flow, or we just dispose of the asset and move on, right? Risk tolerance, return expectations. We look to target between 13, mid to high teens on IRRs, right? Preferred equity, lower returns, less risks is priority on cash flow, but we look for 7 to 8% during the cash flow hold period, and during the entire period, we look to double our returns, right? 2x multiple. right? And again, market preferences, we shared that earlier, what we look for. Questions to ask any sponsors, right? Show me your stress test. What happens if rents are flat for 2 to 3 years? These are questions that you can come and you can ask us, and we will have all these questions answered in the presentation. What's your personal financial commitment to this deal? How are fees and promotes structured? When do LPs get paid? In our deal structure, LPs are what we consider preferred investors. So you guys get paid first, and then we get paid second. That's the way it works. So it incentivizes us to work hard, work fast, push the rents up, do the renovations as quickly as possible, get those rents going, get that NOI up there, pay out distributions to you guys so that we can eat as well. Our invitation, we're not asking you to invest tonight. Don't worry about that. We're just sharing with you what we do, how we do it, why multifamily, and why now is the best time to get involved, and how we go and we underwrite. And we'll be doing more of these webinars. We'll do Dwaine, maybe we'll do a webinar breaking down actual underwriting. Take a property specific and we'll talk about rent roll. We have one of our master underwriters on the call right here. He has the same name as me because he was using my link, but that's Doug. Doug was a CFO of Fortune 500 companies, master underwriter. And we have another gentleman, Andre, who was worked for UBS as an investment banker. These guys are our master underwriters, our thinkers. We use AI now to underwrite and to do all these things. So maybe we'll do another webinar where we break down underwriting so people can see exactly how we do our numbers and where we get our returns from. Yeah, and that's pretty much it. So the next step, stay in the loop. We can schedule a one-on-one conversation, 20-minute goal setting to decide what you're looking for, what your goals are, what your risk tolerance and returns are, expectations, and so forth. That's my address right there, nm@acrel.com. You can check out our website, www.acrel.com. You can also review the recording of tonight's presentation. Dwaine will organize it and send it out to everybody. You'll get invitations to future webinars. And again, if you want to get on a call, please feel free. Multifamilyinc.com/call. That's my scheduler. Feel free to, set up a time to speak with me personally. Be more than happy to answer all of your questions. I started going fast towards the end because I saw that we're coming up on the 10 minutes after 9. There's the QR code. Feel free to take out your calendar, your phone, and schedule a call with me. And that's a damn good looking guy right there on the left. Okay. I'm the only one laughing and smiling at that. I get it. That's okay. But yeah, let's now open it up for questions. Anybody have any questions? Andy asked if this is being recorded. Yes, this is being recorded. Great question. Anybody else? Anybody else have any questions? Feel free to type your questions in, and we'll go. Anybody?
Let me check here.
Anybody? I think, okay, well, if we don't have any questions, maybe if you guys want to raise your hand, if that's possible, or...
It was very effective, so I think you probably answered everyone's question there.
I think so. And again, I apologize for starting to speed up a little bit and skipping some things, but I wanted to make sure that we kept it in the 1 hour time slot. We got a poll or quiz. Okay. Well, guys, thank you so much for joining us. Feel free to reach out to Dwaine, to myself with any questions. We have some great opportunities coming down the pipeline. We'd love to discuss it with you, discuss different markets that we're investigating, that we're looking at. And I want to wish everybody a happy Hanukkah, Merry Christmas, and a solid new year. And let's kick off 2026 with a blast. Our goal just to share with you our goal. What is it, Andre and Doug? 5 years, $5 billion assets under management. That's 5 billion with a B. So we've been on conference calls with Andre and Doug and Karen and Scott, the whole team. We've been building up the systems and processes to make that system fly so that we can hit our goals with Dwaine and everybody on the team. 5 billion assets under management. And we would love to have you guys on the ride with us. So with that, I bid you farewell. Thank you very much for being here tonight. And we look forward to speaking with you.